Hello and welcome to BQ Prime. You're watching Talking Point, and my guest today is Dhananjay Sinha, who is the co-head of equities, head research, strategy, and economics at Systematix. Dhananjay, thank you very much for joining us today on Talking Point. My first question to you is that the Reserve Bank is expected to come out with this monetary policy in next couple of next half an hour or so. What is your take on how the governor would look at the monetary policy, and what could be the MPC's, in terms of commentary and decision?
Yeah, so thank you for having me. So basically, our view has been that, if you look at the last policy statement, the RBI had gone a little bit hawkish, while they were saying that they are more inclined towards removal of accommodation, etc. There has been a spike up in inflation. The last print that we got was for August, it's about 6.8%, and for July it had gone up to 7.3%. These are numbers higher than what the RBI's tolerance levels are, which is at the upper bound about 6%. So that is one thing that would sort of play out on RBI's mind. The other thing is, of course, that from a global standpoint, we know that the higher for longer thesis is actually playing out. I think it's gaining ground, especially in the context that in the US there has been an increase in inflation, and because of the geopolitical issues, there is a sort of a rising crude price also, so which is edging towards 90 to 100 kind of range. So those are the things that are relevant. And we have seen that because of this, the dollar is actually strengthened, and that is putting pressure on RBI, on the rupee, and the RBI has been intervening through intervention. So those have actually pushed up the short-term rates and the long-end yields as well. So those are the things that will require RBI to maintain a hawkish view and possibly indicate that there is a possibility of furthermore rate hike, because if the US rate hike also happens, then RBI will also need to take into cognizance that development. So I think overall, I would say it's going to be a hawkish view as I expect, and possibly the RBI would end up by leaving a possibility of another rate hike.
Do you think the RBI, while the hawkish commentary is expected, may increase the inflation target which it had indicated last time, and also on the growth part of it, we've seen some kind of sluggishness in terms of consumption, and rain monsoons have been pretty much slightly below normal, and that would mean that H2 might be much more, a little more sluggish in terms of consumption coming in, especially from rural sector. So will it moderate the growth rate as well going forward for the next 2 quarters?
So I think it's quite possible. So there does seem to be a sort of a disconnect between how we see the economy and growth, etc. But what we are emphasizing is that beyond the government spending, which has been a huge driver for the overall headline GDP numbers, if you look at the household spending and also the private sector spending in real terms, that is on an average averaging around about 2 to 3% or thereabout. So that is already there. I would say if you look at the performance of companies, the top line growth of FMCG companies or consumer related companies, there we are seeing that the top line growth is almost virtually zero. So I would say, or close to zero. So essentially, the overall demand scenario seem to be weak, and the government is actually driving a lot of top line numbers. And so heavy lifting is being done by government spending on capex, etc. Going forward, I would say that the impulses are not that great, because if you look at the trade numbers, there is contraction out there, and that continues for last several months. I would say 10 odd months there has been a contraction in both exports and imports, and services sectors also decelerated. And many of the high frequency indicators that we look at for services sector that also sort of come off. So I think there is clearly a deceleration, and RBI would sort of in its projection of 6.5% real GDP growth, they are already talking about a slowdown in the second half of the year and the next 3 quarters. So I think those things will be maintained by RBI. Uh, but I would say that looking at the high frequency data, I do understand that it is kind of much weaker than what the official estimates are. So that is one part of it. On the inflation front, as I said, they will be worried about the implication of the rise in food prices and how does it sort of impact our inflation. And how does it impact government spending? Because government spending is not really budgeted for any expansion in non-interest revenue expenditure. So there might be certain increase out there. So there are multiple implications. Things are very fluid, I would say. And you have broadly you have a situation of above target inflation and possibly a much weaker private sector demand, and you have the government doing a certain amount of heavy lifting. So I think that's how I think our things are placed at this juncture.
Dhananjay, if while the direct impact of fuel hike may not be coming through, but indirectly through derivatives, it might
Yes.
come through to various sectors. In that scenario, what is your assessment? Which are the sectors which are now little vulnerable with respect to margins and profitability?
So I think that's a good question. So essentially, if you look at last few quarters, as I said, non-finance companies, the top line growth has actually decelerated quite sharply. I would say fourth quarter last year was about 8%, and first quarter this year was about 0% or thereabout. And possibly it can get negative also as we go into the second quarter. This quarter might be negative, I would say. So essentially, what companies had been doing was to really gain margins through because of the reduction in the raw material cost as they scaled down the cost of the utilization of raw material. The margin expanded as that happened. Some of it was passed on to gain volumes and maintain a certain market share. That was done by large companies. Now, what would happen now is that as the costs rise through various channels and stuff, there is a possibility that that margin expansion story that was panning out in the last 2 quarters might actually wither away. So there is a possibility that margin pressure will re-emerge. I would say, and what would happen is that large companies who have gained market share, they would be able to pass on those costs, increase in costs. But what would eventually happen is that the smaller companies who are into, let's say, typically in the B2C kind of business, they will not be able to sort of pass that on, and the margin pressure will be much larger there, and their ability to pass on the cost increases will be lesser. So I think this dichotomy between large companies and smaller firms will start to re-emerge. Put together everything, I would say the margin pressure will be there, especially in the context that the demand scenario hasn't been that great.
Mm-hmm.
So I think this margin story can actually inverse because of the rise in crude prices. And crude prices, as it rises, it has a percolating impact on other commodities as well. So over time, with a lag, that can happen. What the government is trying to do is to restrain that increase government has actually cut prices for gas, and they are trying to give within the Ujjwala scheme, they are trying to give some subsidy and all. It would also imply that the government subsidy budget would also start to rise more than what has been budgeted.
Do you think that there may be an impact to the revenue buoyancy for the government as a result of this?
Of course, it will be, because if you get the assumption in the budget, they had budgeted for 10.5% growth in GDP growth, nominal GDP growth, and a tax revenue growth of about 10.4%. The first quarter GDP growth in nominal terms has been roughly about 8%. So already there is a sort of lowering in the nominal GDP growth versus what the government had assumed. And we think that as we go forward, you might actually see much lower nominal GDP growth. Our ballpark number is that it could actually average about 6.7%. Now, the government's elasticity of tax revenue collection was 1 versus nominal GDP growth. They had projected a nominal GDP growth projection of 10.5%. The nominal growth in tax revenue has been budgeted at 10.4%. So that ratio is about 1. Whereas our view is that the structural elasticity is roughly about 0.7 or 0.8. So you have a situation of lower nominal growth and lower elasticity, both impacting the tax revenue. What the government appears to be doing is that they are leaning much more towards increasing collection through indirect taxes. So that is actually increasing the overall net indirect tax to value added GDP ratio to almost like a 30-40 year high. And but other thing that they are trying to do is to really do much more aggressive collection on the income tax. There has been a reduction in the tax refunds in the second quarter. As the numbers for September has come out, it is showing that there is a at least 20 to 25% reduction in the tax refund over last year. So government is trying to look at multiple avenues to compensate for the possibility of a shortfall. But if the nominal GDP growth continues to decelerate, I don't think you can actually implement some of these one-off things to really compensate for the falling nominal GDP growth.
I was seeing at some of the reports and numbers for direct tax collections, they were much lower than the projected ones, requiring the government to go above 14% growth in the next 2 quarters to meet them. Do you see that, given the fact that you have now margin compressions coming in because of the fuel consumption issue which is there, uh, the corporate tax collection may be falling short in this fiscal, and hence the
Absolutely.
property
So I
and
think
hence the profitability will be impacted?
yeah. So I think if you look at FY 2022, the profit growth for Nifty companies, for instance, that represents also, it could be similar for other larger set of companies. So the profit growth in FY 22 was about 40% thereabout. In FY 23, the profit growth was roughly about 11.5%. And if you look at it, the trailing EPS of large of Nifty companies, that has come down to roughly about 3.4% growth. Then it's quite likely that it might actually sort of flatten as we go forward because of the margin pressure and the fact that your top line growth has actually started to flatten out. There is a possibility that the indirect direct tax coming from the corporate profit might actually come down. And as we know that the corporate profit tax rates had been reduced in 2009 FY19. So that is already reducing the contribution of corporate tax in the overall tax collection. So if you look at incremental tax collection over pre-COVID levels, and especially the surprises that has happened post the COVID, it's largely come from indirect taxes and higher income tax than corporate tax. So upside surprise on tax revenue post COVID, that corporate contribution is just about I would say 55%, 60% has come from indirect taxes, and the balance has come from income tax. So I think the dominance of corporate tax in the overall tax collection has actually come down. And as we go forward, as the profit growth starts to come off, it's quite likely that given the lower tax rate, the dominance of the share of corporate profit tax in the overall tax collection will actually decrease even further.
Mm-hmm. Given all these factors, in how much is the Nifty earnings that you're looking to grow, looking at growing by in FY24? Given that we have already closed 2 quarters and 2 quarters to go. Uh, FY23, you said 11% growth that was coming in. Do you see
Yeah.
sub 10% coming in FY24?
So the consensus estimate for FY24 and FY25 is roughly averaging about 16%, right? So according to us, it's a very tall task. What we believe is that if you look at the pre-COVID trend and the projected numbers for FY24 and FY25, the deviation is roughly about 70%. So this is a very tall task, especially in the context that if you look at the trailing EPS growth is just about 3.5%. So and it is kind of decelerating from last year. So as the momentum comes down, the ask rate for meeting a 60% growth this year and next year will become far more high. So the ask rate would be very high. So I think there is a possibility of downgrades that can happen. And now I think in this particular quarter, because of the margin pressure that is there, if you look at various companies, there is a lot of expectation that following the festival season, there will be during the festival season there will be a good demand. This is shown across this has been seen across multiple sectors, including FMCG, autos, etc. These are some sectors which are actually seeing reasonable volume growth. There, people have actually stocked up a lot of inventory and all. We need to see whether the festive demand is good enough. If it is not, then possibly there will be a heavier discount following the result season, the festival season, and that might start impacting their top line in the following 2 quarters as well. So I think there is a lot of hope that we sort of gather from what companies are talking about. Those things are there, but we'll need to see whether the top line growth and the pricing power of companies remain as strong or not. So if it dissipates, possibly there will be a sort of correction as far as expectations concerned. Our own view is that there can be about 15% downgrade in terms of earnings. So that would imply that you would have a very flattish kind of a EPS growth in the next 2 years.
Dhananjay, it was a pleasure talking to you today. Thank you very much for joining us on BQ Prime.
Thank you very much for having me.
That was Dhananjay Sinha from Systematix. He was giving his view on how the earnings are going to be and what he expects from the Reserve Bank of India today when it meets to announce the MPC decision. Thank you for watching BQ Prime.